And hello, and welcome back to the Mortgage Mythbusters.
Welcome back.
I'm Paddy. I haven't seen this guy opposite me for quite some time.
Well, yes.
It's been nearly 6 weeks. So remind me.
What, in front of a pod microphone you haven't, but you have seen me quite a bit.
The Barry I know personally is a complete different person.
It is. If I don't get paid, I don't really engage much.
We capture him when he's sober for these podcasts. And just remind me, so it's Baz, Barry.
Yep.
How do you?
Either or.
Either or. Or as I've already introduced you to our guest, who we'll introduce in a little bit, is Carl Pilkington, as we know.
Yeah, that's sad. Yeah, it's debatable.
But it's been that long. So the last time we did this, we had Darlington Building Society in.
Mm-hmm.
And we busted.
It was a while ago, wasn't it?
It was a while ago. And that was, we believe, episode 21.
You believe episode 21.
Episode 21.
No, yeah, you believe it. Yeah, I think it could be 22, but yeah.
So this will be episode 22.
Right.
But it was episode 21, and it was definitely season 2, episode 3.
Yep.
And we busted the myth of building societies, and that a building society are tough to deal with. At the same time, we also busted the myth of credit scores, and that you need a good credit score to get a mortgage at 95%.
Yeah, it was good. It was really good. There was a lot of sort of tangents came out.
We had Chris and Kyle in, didn't we?
Yeah.
And we realised that Chris was in the wrong profession, and that you should do podcasts all the time.
Silky voice.
Yeah. Have we got that one out yet? Is it on Spotify?
I think so.
Obviously, it will be now when someone's listening to this, because this is
the
one after.
Could be. We can't be held accountable for anything.
So
incorrect
just on that, Baz, because it has been a long time since we did it. What did you learn from that podcast?
Pretty much what you said, really. We totally busted it. There were the depths that they'll go to make sure they can accommodate you in the same way that a bank would. We also got into a lot of how the sort of morals of them as a building society, and how it's not like just some massive rich fella at the top that then it comes down and down. It was quite nice how it was the sort of ethics behind it.
It's the way it wasn't just down to a computer, and it was let's listen to the story and let's see what we can do. And they wanted to,
which is what you always touched on from day one, haven't you? That different people have different needs, so different lenders are more focused on.
Yeah, I think
people,
if it's straightforward, what we were saying was that's what the banks in the high street are there for. They've got the best rates, and therefore the vanilla, the straightforward. Now, when we had something a little bit different, where you needed to explain something and you couldn't actually tick the box, what we found was that the building societies really took a hold of that, especially the ones we've had on, obviously Charlie and Darlo. Then the way that they do it is they're not going to waste your time, and if it doesn't fit their criteria. But what I liked about Darlington, especially, and I've always liked this and always talked about it, was the pillars. Yeah. So that out of the 4 pillars, if one of them was a little bit wobbly, then actually the other 3 would still hold them up.
Kind of compensates for it, doesn't it? It was good. It was good. I think it goes back to probably one of the first podcasts we did, where you said that if your bank tells you can't have a mortgage, you can't have a mortgage. And that's not true, obviously, and there's a lot of different avenues to go down. It's just finding the right people for you sometimes.
100%. And that still stands today. Yeah. We like hearing when someone says, I can't get a mortgage, or I've been knocked back, because that's when we're really tested and when we need to do our job.
It's probably the most serious we've been. I don't know if this break's helped or not.
I think you're just getting really good at mortgages.
Yeah,
Yeah,
probably.
And you probably talk about them in your spare time as well.
Oh, yeah, I love it. Yeah.
So this now is an interesting, entertaining podcast, not just an educational one.
I'm sure there'll be a few dumb questions along the way, but
right. So episode 22, and we're introducing
22
our
or
guest.
23. We'll find out.
We're going to say 22, but we're introducing our guest, and this is Hema Patel from Hodge Bank, or Hodge for intermediaries, as she is today, because she's dealing with us, Park James Solutions.
Right. So I'll jump straight in. So you're saying it's Hodge for intermediaries?
Yep.
Or Hodge Bank?
Hodge Bank
for intermediaries. So is Hodge for intermediaries is Hodge Bank the umbrella above that, and that's like an offshoot of it? And what's an intermediary?
So intermediary.
First of all.
So thank you for having me today.
Oh, yeah. Get the pleasantries out of the way.
So Hodge for intermediaries basically means that we don't have a high street presence. We are a specialist bank, but we just deal with mortgage advisors, so intermediaries. Sorry, not just mortgage advisors. Your mortgage advisors, your wealth advisors, your pensions advisors. So we deal with the intermediary market. So a consumer wouldn't be able to just walk off the street and come and deal with us direct. It would need to go through a broker.
So like a middleman in effect between the customer and yourselves. Okay. So is that side different from Hodge Bank?
Yes.
So what's the difference? Is Hodge Bank an actual a high street presence then or not? Or is it still not? Okay.
Presence. So we're a specialist bank. We're based in Cardiff. Been around since 1960s. We have 3 arms to the business. So we've got our commercial arm, our savings arm, and our mortgages arm. And Hodge for intermediaries is the mortgage arm.
Okay. So with that, so that's the mortgage arm. Are they linked together still in any way? As in, when we've had, you're going to correct me because I'm going to be totally wrong. When we had building societies on,
Yes,
it kind of all came from the same pot, if you see what I mean. Do you know what I mean? Is it all linked together? So one, say your mortgage rates will be, is that governed by how many people have savings with you and things like that? Or is it?
Yeah, so...
Does that make sense?
Absolutely,
vague with this.
Yeah. So our savings is... so money... So basically, imagine an office. And on one side, we've got a savings side.
Yep.
So the money comes in. And then the other side, we've got our mortgage side, and the money goes out.
Right. So it is, So it's all...
So it's a building society as opposed to a bank almost as well. Yeah.
So why, first of all, is there no high street presence? Is there a reason for that? Or not?
Has there ever been?
No, we never.
No.
That's pretty decent though. I mean, was it Nationwide have said that they will never close branches, and then there's an asterisk saying and this fact or this statement is correct up until 2030 or something like that. So they're saying we will never close branches
until
then they're saying at least until then. Whereas you're dealing with professionals like intermediaries, and the commercial side of it, which should be interesting to talk about, but also the savings. The way that the myth, that we're going to bust today, which will lead us onto a deeper conversation, which I think is really interesting, is that you can't get a mortgage for an Air B&B property. And the reason that this is the myth is because it's a lot of the time it's something that I come across that people are doing or want to do, but they go the long way about trying to explain that's what they want to do. So
what do you mean by that?
So they are looking to get onto the property ladder, but they don't want to live in it. They're wanting to look at investments. And they're also very interested in the prospect of renting out like a holiday let. Okay. Now it's quite a new thing. So when people started doing it, it didn't really exist. There wasn't products for it. I mean, there certainly was, but there wasn't products that were just the kind of on the bus shelter window advertised. But you do have your specialist lenders that will do holiday lets, whether it be via a professional agency, like we get in Lakes Estates and things like that. But then Air B&B obviously came on the scene, and it was more not written into criteria because they didn't exist. But so people who say, I'm interested in Airbnb and I want to get a mortgage, probably think that there isn't anything out there because there isn't directly for them. They have to come to a broker who uses a bank or building society that offers products where they can do that legitimately, very straightforward as well, and actually get a mortgage where they can run a business via Airbnb. So the myth is that you can't. I've just busted it straight away. But then in steps Hodge, who specialize in that area. We deal with them quite a lot in that, and it's the first lender that kind of would come to mind because of the rates and because of the arrangement fees to do it. And also, I take it you guys have that as your niche for a reason. You see it as profitable. You see it as something that there's a gap in the market, and I think you've run with it. And you've done well.
It's not the only thing you do, is it?
No, absolutely not.
But it's your niche. That's your main. Right, okay.
So just to kind of go back to the beginning. So Hodge initially were known as an equity release lender back in the day. We're first to launch an equity release product.
Okay.
We brought equity release to the market. And however, just to put it out there, we no longer do equity release.
Okay.
Our vision is
So,
to become...
Go on, and equity release is basically the money that you've got. So say what you bought your house for to what it's worth now. Is that right or not? Or what you've got? I don't know. Go on, you go.
So equity release is basically releasing money from the property for your mature borrowers as you're going into retirement. It's for clients who are probably asset rich, cash poor. It's not like a residential mortgage.
Right.
So it's not affordability assessed.
Right.
However, as I said,
But they don't,
Yeah, I mean, there are so many equity release specialists out there.
Yeah.
So that maybe that's...
It's a real difficult market. It's an extra qualification on your belt from a mortgage advisor, mainly because of the vulnerable side of it. Lending money on an equity release is really complicated. It has to be done face to face, usually with third parties present, whether it be family, because you're potentially looking at a property there where you're releasing money, and generally there isn't any payments to be made whilst alive. The money's rolled up in payments, and then at the end of the amount is kind of a lot greater than they originally borrowed.
Right.
So the equity release market is something that is needed, 100%. But also it has been kind of modernised. Like guarantor mortgages have been modernised with the joint borrower sole proprietor. What they've now done is kind of release products where they can have a bit of best of both. And that's one of your new specialty, or not new, but it's something that you've evolved, I suppose.
Yeah. So as I said, we no longer do that. Our vision has changed. Our vision is to become more of a broader specialist. So we still serve that demographic with our two other products for our mature borrowers, which is our 50 plus and our Rio. And obviously we also do our holiday lets and professional mortgages as well. So taking clients up to and into retirement.
Right.
Baz, she said Rio.
Sorry.
Tell me what you think that is. No, I like putting Baz on the spot.
What
do you think it stands for?
That was did you say supporting them into retirement and Rio? Is that what you said?
So we've got our Rios and our 50 pluses.
Rio.
We've got
retirement.
Yeah.
Is that right?
Yeah.
Investment.
Nope.
Retirement.
Think mortgages. What do you pay? What do you pay?
What do you pay? Mortgages. Interest. Retirement, interest, options.
Nearly.
Only. So
go on then. So
if I was, I'll tell me if I'm right. I mean, I should be, but this is kind of equity release, but you're making payments of the interest so that it's not rolling up.
No, so it's similar in the same arena, so to speak, for mature borrowers. However, a retirement interest only mortgage, it's based on affordability, unlike an equity release, and it's a lifetime term, like an equity release. So it is a lifetime term. Interest is paid on it, and it is the loan is repaid on the client passing away or going.
So when you say lifetime, you mean that it's the person's like so I come to you. Is there a certain age that this starts at?
50.
So starting at 50, I come to you and so what would be a rough example of what I would need that for? Is that to buy to let or something like that, or what would you need the money for in effect, or is it? You
can use it for various reasons. I generally categorise that kind of client in, you've got 3 types. You've got your assist, want, and need.
Okay.
So your assist would be like your banker mum and dad, or your banker grandparents who may want to support family members, children, grandchildren on the property ladder, maybe buying a bigger property because they've outgrown the current property. They may be the children may be going through a divorce, so they may want to buy the other partner out. Then you've got your want clients, so they're the more aspirational ones.
Yep.
Some, as you say, maybe a second home or a holiday home or a buy-to-let, or maybe that dream holiday or that dream car. And then you've got your need clients, so what you would say maybe as a silver splitter, clients going into retirement and deciding they no longer want to be together. So it could be used for that. It could be used for these interest-only maturities where clients took out these mortgages many, many years ago, and now the banks or building societies are asking for their money back. So a lot of these clients probably cashed in their endowment policies many years ago. They've got no repayment vehicle, and these banks and building societies are now calling in on their loans. And these clients are probably still working, and a lot because they have to, not because they want to, especially in the current climate as well.
Yeah. So my mother, this is great. I love bringing my mum into this because I can talk about her in terms of her situation. So say back in the day when you took a mortgage out for 25 years and you were advised to take it interest only, okay, because that may have been the advice, and you had an endowment that ran alongside it, basically just a pot under your bed that you used to put money away, and you hope that would be enough to clear the mortgage. If they didn't perform, there was a shortfall. So people came to the end of their mortgage life with that particular lender, and they still had a balance to pay. Okay, so they would then come to me and say, right, I've still got a mortgage, but I'm actually nearly retired, and I need to do something about it. So if you put that on a mortgage where you had a restriction on the age, so that might be a max term to age 75, and a client's coming to you at age 65, to put that mortgage on a repayment basis for 10 years is going to be extremely difficult for someone to keep their home. So we needed a part of the market that came in and serviced these clients, and that's where the RIO comes into, especially without an end term, because that interest-only mortgage allows them to effectively have an interest-only mortgage forever. But also, if they wanted to, they could make lump sum payments to the capital to be able to reduce that.
So you're chipping away at it, just the interest, a little bit at a time.
Yeah.
Just the interest. So when you say chipping away, you're not chipping away. You're just paying the interest. The balance of the loan stays the same.
Still there.
But if you wanted to, and you had the ability to, under your own control and your own affordability, you could make additional payments, whether it be monthly, yearly, to bring that balance down overall. Whether, again, that is still putting money under the bed, or some clients may think, well, actually, I'm happy to, at the end, when I'm no longer here, the property will be sold, the mortgage will be paid off, and the proceeds, the equity will then
All right. See, that's what I was kind of thinking, like, what's going to happen? Because if someone passes away, you're left with them owing money, but obviously they're not, because you've got the property there that would be auctioned or whatever else. So for me, for instance, I don't know, if we said I was 55 and I wanted to buy a buy-to-let, say, something like that, and I come to you, so how would that work? My house is worth, I don't know, say £300,000. I've still got, I don't know, X amount to pay on it. How does that work then? Because I've still got my mortgage.
So you'd need to pay the mortgage off because we'd have first charge on the property.
So does that mean you would give me the money
to pay that
off, and then I'd just be paying that back to you?
Yes, right. And you'd borrow a little bit extra for, say, you wanted to buy this buy-to-let property or whatever it was. But it'll still come down to affordability. The difference between that and equity release was you can have, let's just use 50%. So you've got no mortgage, but you wanted to borrow 50 grand on a 100 grand property. An equity release, here's the money. It would roll up the interest, and whenever you died, that interest plus the amount you owed would be taken by the bank. Okay. Now, with an interest-only RIO, with what Hodge here talking about, that just allows you to do the same, but you're paying the interest, and you're not accruing that interest balance, but you've still got a debt. Now, you would be paying off the existing lender, which is whoever it is, and you'd be borrowing more to do it. But it still needs to be, the difference between here's the money and take it and a RIO is you've still got to be able to afford it. Now, they're not going to assess your income based on you being 99 on your employed job, because you're not going to be in that employed job. They need to look at income into retirement.
So that obviously pensions and things like that.
So if you only had a state pension, there's not a chance you're going to be able to pull out 100 grand to keep forever.
But for instance, if I wanted 100 grand, interest was, I don't know, 5%.
Yeah.
So whatever that is a month.
Right.
So if I wanted that, right?
Yep.
That's all I would pay off. But at the end, when I die, I would still owe you the 100 grand. Is that right?
Yeah, the balance would still be owed. Yeah.
But the house would sell. So if the house sold for 150, I would give Hodge the 100, and then the 50 would be as my whatever's left for inheritance to.
In theory.
That's the basics
theory,
of it, though.
Do you know what? It helps mortgage prisoners, and that term mortgage prisoners, the people that get to age, let's say 65, their mortgage should have been paid off because the endowment should have performed, and it didn't. So they've actually got to retirement, and they have a mortgage balance to pay. So two things are difficult there. One, they've got a mortgage, and they didn't expect to have one. And the other one is that any lenders on the market that are going to look and assess them for a mortgage are either going to have them a very short term, or they're going to give them a longer term. So let's say to age 75, so 10 years, but they're going to make it a repayment mortgage. And therefore, to pay off that lump between now and then, that would be a hell of a lot of an expense for your last 10 years of your life
you're
that
not
you didn't
just
expect.
Yeah, okay.
So having a RIO in there gives you an indefinite date, and it's interest only.
So when you mentioned endowment, that's not something I've heard for a long. Is that something that they don't do now?
No, it's
endowment's not really.
The term's still out there because it's still a product. But what it was almost like it was sold back in the day as a guarantee. Don't give the money to the lender, give it to the endowment, and we'll gamble the money away, and we'll make that bigger than the mortgage.
So it's an investment.
It's an investment, yeah.
But obviously, like any investment, as you hear on all the little notes at the end of the advert.
It's a sore subject for people because it did leave almost the majority of those people in that particular era short, and my parents included.
Soul killing, isn't it?
It is.
Really?
I mean, obviously, property prices go up, so there's a greater equity, and there's another repayment vehicle at that age, and that's downsizing. You sell your house, you pay off the mortgage, and then you move. But some people's homes are the reason they're still alive because it's the walk they go on, it's the garden, they've got the sunset and all that. So if they can keep that property and there's a way to do that, that's where the RIO comes in. But just not to get, because you know what, the RIO is so complex. And
do another one on it.
It's retirement, and I'd rather bring a equity release expert in here alongside to rebuttal it, because not everyone can make these interest payments. Interest only isn't expensive at the moment. Sorry, is expensive at the moment because rates are 5-6%. But to touch on the Air B&B side again, I think that's where our listeners are going to be really interested, because I read earlier, and I did a bit of research, that you can do this without being a non-owner occupier. So you don't have to own a home, and you can buy a property as a holiday let.
You've definitely done your homework.
For the first time, isn't it?
But
tell him he's wrong.
So, but why that's interesting is because not everybody wants to get on the property ladder. Not just saying that everyone who wants to be a professional lives in London, but it's expensive down there. But what they could do is purchase a property up here if they had the deposit. It could be a holiday let, so an investment, without owning their own home first, which is normally a criteria that a buy-to-let lender is keen on. They don't all want that. So therefore, you could have your first investment property up here. And am I right in thinking, again, that they can actually stay in that property 90 days of the year?
Yeah.
So their annual leave they could spend in this holiday let, and in the meantime, it's actually making them money.
So rent it out on Airbnb, say.
Yep.
But then, like you said, so you've, I mean, it's something we've thought about doing definitely, for whether it's Airbnb or, I mean, the dream's obviously to have somewhere nice and hot abroad, isn't it? But I think it's, I mean, that leads me on then, I suppose. Is this just for UK properties?
Yes.
So it is just for UK properties?
Good question.
And is there a difference, or is it just wording? Is it just the way Paddy's worded it? Is there a difference between a holiday let and a buy-to-let, or a holiday let and an Airbnb? Are they all the same thing in effect?
A holiday let is a short-term let.
So as in, what's the range there then? Is there a range it goes up to?
So the buy-to-let would be 6 months.
Is that a long-term
6
tenant?
months. They've got assured short holds.
Yeah.
So it's still 6 months is quite short.
At least 6 months.
6 months. And that's a tenancy to an individual, whereas a holiday let will be to many individuals, sometimes for a day, sometimes for a week. And that way it's completely different. But actually, what we're seeing more now is those lenders that do both, their rates are very similar. In a way. So it's not like having a buy-to-let is going to get you a much better rate.
I suppose there's no
It's an investment.
more risk, is there really? I mean, if people haven't got the money to go on holiday as much, you're at risk a bit for the Airbnb, say, but then if you're renting it out long term to someone, and if they're made redundant or something, then it's at risk. You know, for you, as the owner of the property, in effect.
Yes.
So it's, I suppose there is risk there. For a lender like yourself, it must be quite hard because you're not just judging it on, say, Paddy comes to you and he wants to buy a house. You having to trust that they're going to be able to go out and get this house, someone in it, or rent it on Airbnb to get the money back to give back to you. So there's more risk than just a normal.
So how it's assessed? So the holiday lets are really straightforward. As Paddy said, you don't have to be owner occupied. You could be in rental accommodation. You could be living with parents, and it's what it's assessed on. It's assessed on a 30-week assumed occupancy. So a letter would be required from a local or a national lettings agent, and it would be assessed over a high, medium, and low season.
Okay.
We would do a sense check just to make
So
sure.
on some of the properties that are close by that are doing the same thing, right?
Yeah.
Okay.
And then, as you say about the risk, to go into that is we do a sense check just to make sure that they can cover any rental voids.
Okay.
Okay, so it's to make sure that they've got the disposable income if they needed to, which is sensible because it's a business. You're running a business. The buy-to-let is someone else moves in and you ideally, and it doesn't work like this, ideally for 6 months, they pay the rent and they extend then for another 6 months and so on and so on. Whereas an Airbnb, you are running a business.
Yeah.
Whether it's through Sykes Cottages or you're running a business because you'll need to turn around the property. You'll need to obviously manage it and talk and liaise. I've got a holiday let myself, and we once got asked where the rolling pin was, and it was at midnight. You know, you're running it like Air B&B. You are effectively still at reception for the hotel that you're managing. So it's a completely different type of business. Whereas a buy-to-let is very much you buy a property, you stick a tenant in, and if you wanted to, you'd have the estate agent kind of being the middle person. With this, you're running it unless you pass that out to a third party like Sykes. Whereas Airbnb,
but then you're going to be given a percentage or whatever, aren't you?
Yeah, I mean, there is now a lot of companies set up there running it via Airbnb. So they've still got a middleman like a holiday lets agency because the platform's fantastic with Airbnb. I'm sure there's others out there, but it's brilliant. It works both for the guest and the owner. And for booking, I know hotels around here use Airbnb for booking the hotel. So just even like the New Crown Inn at Bolton, where I live, that's on Airbnb as well as it is on booking.com. Right. So that tells you a lot. But whereas this is buy-to-let is very much buy it and that's my investment, I'm leaving it. This would be running a business. And it can be very profitable. And by Hodge looking at that from a high, medium and low perspective, what they're doing there is saying, even if we hit the low range throughout, we can still make enough money to make this a profitable business and pay the mortgage payments. Whilst also, if for whatever reason we have COVID again, and they're limited to just key workers staying there, they can afford to cover that shortfall, as in the mortgage payment. So it's quite a sensible way of doing it.
So in effect, like the way it's always been kind of sold, you know, the dream that's kind of sold to you is you get someone in there, you own that, you've got the mortgage on that. You get someone in, charge them more than what the mortgage is, so you have a little bit extra there, put to one side. So does that obviously differs from where you've got no income in your residential property. Does that mean is there more scope to pay back more, like a higher repayment option or anything like that? So say I'd made an extra, I don't know, £10,000 that year. Can you knock it down quicker, or is it just the same as a normal residential mortgage?
Same as a normal residential, just 10%.
Is that what it is? Okay.
You'd probably, I mean, we could get into real advice here and talk about limited companies and things like that, and how they could use that money to do whatever they wanted to do. As in, when someone comes to us with this in mind, it's a whole 1 to 2 hour chat about what about this, what about that. You don't get someone that comes and says, I want a holiday let buy your Airbnb and I want to do this. You've got to talk to them about the back end of it and the running of it, how they wanted to set it up. And then I'd come to the floor and say, what lenders have I got available for this type of scenario? So it might not always be Hodge, it might be someone else that would want to look into it. But no one, especially because I've just advertised the fact that you can buy it as your first home, Airbnb done.
Yeah.
That would be irresponsible without education and without them understanding the market.
Absolutely.
And having someone lined up to manage the property. That's the biggest thing. You know, managing the property is what gets you your guests coming through the door, and gives you an easy time. But to me, what it is just highlighting, because the myth I'm busting here is you can't get an Airbnb mortgage. The reason I've brought that myth up is because I get a lot of people who I think customers, no one comes to us and says, I want to commit fraud and I want to do anything. What they do come to us is, please educate me because I'm thinking about doing this. Does that exist? And they will, I'm thinking about buying this, but I'm not too sure. I'm going to stick a tenant in, but I'm keen on the rental side of it. And I don't know what I'm going to do. Also, when I'm home, am I able to stay in the property? So that they've already thought of a product that exists, but it's not advertised. But for one, it's via intermediaries. So actually, I'm saying, well, Hodge do this because you can buy that property, you can run it as an Airbnb, and you could stay there for 90 days of the year if needed. So the odd weekend that it's free, you've given yourself a free hotel to go and stay at. So all those things that they probably thought, I want to do it, but do I dare say everything up front because I don't know. Things might change. I might be fine down here. I might never get a chance to go home.
See, my naivety,
all these
before
options.
we started doing these podcasts in general, like I just thought it was easy. I thought you just like, if you want another house, it's like buying a house.
Do what you want.
And that's just because of no education in thinking about that. Because I mean, if I'd have done that and then bought it and then found out that you need a buy-to-let mortgage or whatever else you need,
and that is the main problem in the market is people will do this. People will buy a property and stick it on Airbnb, and they'll be naive about it, thinking you can do. But one of the checks that lenders do is if they've got the spider senses that maybe this wasn't positioned or submitted in the way they had, they won't just leave it there. They'll look after 6 months down the line. If that pops up on Airbnb, you're in trouble, you know. And that's the education that we have to bring to people. And that's where it, like I always say to you, Donna, there's a mortgage for everybody. Tell us everything, absolutely everything. Like people might have aspirations to go and travel the world in 3 or 4 years' time. If you go and tell your bank that, then the bank's going to say, well, how are you going to pay your mortgage in 3 or 4 years' time? Things could, your first, and I'll bring it in, twins, like your next, Baz has got a set of twins after already having his boy, girl. So the next child, as I was afraid of, was twins when it was, you were expecting just to have your third child. But I always use that as an example of you never know what's around the corner. And if you need that extra bedroom or a new bloody house as well. So you never know. So anyone that's coming to me, especially my military clients, and trying to talk a 5-year plan on a mortgage, doesn't exist. Too many things can happen when you're buying a first home. You might not like your neighbours. You might need to move. You might not like the school. You might get that job offer in Tampa Bay, which does happen a lot in the military.
But this has shown, the last 5 years has shown this, hasn't it? How crazy the world is and how things change.
Oh, absolutely. I mean, our holiday letter proposition that actually came out, and I don't know if that was a stroke of luck or genius, but it actually came out just before we went into lockdown.
Did it really?
Yeah. I promise we don't have a crystal ball. Again.
I don't know.
But as you say, you just don't know what's around the corner. And that's why I would like to also highlight, in respect to the holiday lets, is our early repayment promise.
Okay.
So it's something that's unique to ourselves. And going back to the equity release world, it's quite common in that world, known as downsizing protection.
Okay.
However, with ourselves, early repayment promise is really straightforward, and it applies to a holiday let. And we incorporated it in our residential products, our 50 plus, our REO, and our holiday let, to keep that USP, because, again, as you say, people's circumstances change. So let's say you took a holiday let out and your circumstances change, and in the next year or two it's just not worked out feasible for you. You've got a 2-year fix, for example, and in the first year towards the end you've decided actually it's not working out, I'm going to get that paid up. We would allow the client to do that, and you could be a first-time buyer, first-time landlord, and it just not worked out, and we would allow them to do that, and they wouldn't be incurred any ERCs.
So that's above what you said earlier about the 10% that you can pay. So how is that different to the 10%?
No, the client just pays the loan off, and we
totally paid off
within the fixed
so not
period.
Not putting a bigger chunk in to knock it down. It's literally
so
just
this is because of mitigating circumstances. It wouldn't be I've just inherited money and I want to clear my mortgage and I'm going to keep the property, you would say then you incur the fee. But you're doing it for people that actually their lifestyle dictates that property needs to be sold because they might need to release the equity to go and buy the family home. Wow.
So is that something that
it goes back to the morals of like building size, doesn't it? And kind of thinking treating people how we'd want to be.
It's a big thing. I'm not saying it's a get out clause, but in effect it is. It's a peace of mind that if you try it, it's like you're always taught you've got to try things, haven't you? And if you try it and if it really isn't working out, it's good to know that there's an option to kind of.
So is that something that you would put in the Bank of Baz?
No, yeah, I'd like to think so.
Can we hold you to that?
Yeah, possibly. I like the idea of this because I think it's also like
because it'll be protected via solicitors because to repayment of the mortgage or the sale, you couldn't just repay it and then not sell it. You know what I mean? So
it's still going to have to get it. You're still going to get your money back. Yeah. At the end of the day. Absolutely. But I think, it's the other side of it is like it's almost like an entrepreneurial thing that you're pushing as well, aren't you? Because it's giving someone what could be an extra income to them. Like you said, it's a business if it's an Air B&B. Yeah. And I think it's a good thing there that I know there's always going to be risk, isn't there? And things like that. It's not like your own house where you could be set, that's my house for life.
Yes.
There's obviously things that could happen that could change that.
Like I've got this house and I'm moving up to the next one, then you're going to pay the penalty.
Yeah. But I think with this, it's something that it's a dream to a lot of people. But now with Airbnb, it's a lot more available.
That's a good link into what I'd like. This is the bit that I'm going to be educated on, is the professional range. And I think you'd like this for Bank of Baz. So I think it would be good for Hema to explain your professional range because it's what every bank should be, not necessarily professional, but every bank should use an approach where they understand that not everyone's circumstances will be the same in 5 years' time.
Okay, yeah, right.
Yeah, so about a year and a half ago, we launched our professional mortgages. And again, that's for a variety of professions. So it could be your doctors, your dentists, your vets, accountants, actuaries. However, we also overhauled it from when we initially launched it. So we now have mortgage advisors, we have the blue lights, we have teachers, so pilots, IT consultants. So ultimately, what we'd be looking for is clients whose income's on an upward trajectory. And there's no minimum income on this product either, because when we initially launched it, we had a minimum income based on a single applicant or a joint applicant, but we've got rid of that. We just took feedback from advisors like yourself, Paddy. And again, it's for clients 21 and above, taking them straight into retirement as well.
So could that be, for instance, like a newly qualified teacher, say? Yeah. So at the bottom of the pay band scale?
Yeah, because their income will be on an upward trajectory.
And what happens then, as their income grows and things, does that have any effect on the payments? Do the payments go up as their income goes up, or is it just stay the same, or...?
No, it'll stay the same, obviously, for that fixed period.
Yeah.
But ultimately, if they've got like a promotion coming up, or if they have, we look at all sorts of various types of income. If they've got commission, they've got overtime that they do.
Yeah.
We'll take all that into consideration.
Right.
So, like to say again, using the common sense approach.
Yeah.
We look at each case individually.
This is the thing that lift certain companies up against others, isn't it? It's, as you've said from day one, it's different people being judged on their circumstances only. That's a massive thing, isn't it?
Absolutely.
And it's just good to know there's options out there, isn't it? Really. So with those products, do they differ much in interest rates and things to normal mortgages?
They're thereabouts, around early 60s.
So it's not basically saying
not taking advantage of by putting a high rate out there.
Yeah, it's not saying we'll give you a mortgage, but it's going to be when you get your promotion you can comfortably.
So is it an enhanced multiple?
Yeah.
Okay. And when we're saying enhanced, is it
what does that mean?
Bespoke to the individual, or is it like
it's bespoke to the individual? Yeah, based on.
When you say enhanced multiple.
So income multiple is a myth itself. So everyone assumes they earn 30,000 times it by 4.5. That's the max they're going to lend. It's not a bad gauge, you know. But there are lenders out there that'll do more for certain earners. So high earners, there may be a bigger stretch. And then
professional, like what you're saying there is you're not just thinking they're going to be on the bottom of the pay band for the rest. So
absolutely.
Right. That's really good, that, isn't it?
I mean, it's a risk,
but
I mean, the FCA govern all of this anyway. In terms of how they would look at what we can and can't do. So there is a percentage. You're not allowed to just grab every professional in the industry and take them on your books, because you'd end up in the days of the Lehman Brothers and things like that. But it'll be a mandated underwriter making an assessment that say everything else fits, because I'm presuming you're looking for the normal stuff like good conduct and things like that. So you're basically saying this person's going places, and with this little bit of extra stretch, we can help them get a mortgage, and we know they're going to pay it back, because no one lends without signing it off. And every underwriter with a mandate always uses the theory of, would I lend them my money? Because it's on their head, be it should there be a delinquency or anything like that. So it's definitely
how does it work for self-employed? Or does that not?
No, we do. We look at self-employed.
So it's still self-employed.
Contractors,
So I'll wait, because that's a good question for the end.
Okay. The anticipation.
I think. So, or I can just move on to the questions. If you want me to move on to the questions now.
Just staying on the professional range. Do you have your normal range as well, or is professional the niche range? Is there
professional's the niche range?
So the good news is I'm going to come to you with like I would a building society. I'd come to you with my story of my client. I've got this client. You then go away and come back. That's good, because it's such a IT driven industry. Where the computer says no. Even my sourcing system says no. So I need to come to you to be able to say, here's my case, and then you're going to take that away and come back with a figure. That's fascinating, because you know what? I'll have had customers that I'd have told them that is the maximum that they can achieve, because we have systems in place to do that. And it does filter. But if I'm missing the opportunity to come to you and say, whilst I'm at it, here we go, then how do I know that I didn't allow the customer to get that extra bedroom they needed? You know, so that's me learning something today. There you go. That's good. So I'll pass that back to you then, Baz, for your 3 questions.
Yeah. So with the professional mortgages, so say it was a nurse that is in a certain part of their profession, they're looking to move on, which would be higher pay scale. Do you have to get any kind of guarantees from who they work for and things like that to say that this is happening? Or is it like, how does that work? Is it almost you have to jump through more hoops? No. So it's not more scrutiny on the individual, right?
No, but that's like any profession you could change.
Yeah, but you're saying that usually I would have to provide 3 months bank statements, say, but I can't provide bank statements for next year.
No, of course.
So what I was meaning is, how do you get that guarantee that this is going to happen? Now, I haven't just walked in and said, oh yeah, I've been touted this job. I think I'll get this job in 3 years. That's what I was kind of...
I think, are you doing it on a basis because your list of jobs is jobs in demand, like the IT sector? I wouldn't say mortgage advisors, but NHS.
But they are on the list.
They are on the list, and it's one where, to me, it's kind of saying, is this person, if they weren't to continue in this, are they going to be employable in these professions? They've done something extra to either gain a qualification, or in the likes of the blue light services, they've taken a leap into a selfless commitment, which means they're a different type of person.
Yeah,
as well.
Of course. Yeah.
So I think it would be more about employability as well.
And the other sort of side of it, if this person doesn't want to move on with a career and they want to stay where they are, they're happy where they're at, comfortable, they've still got to pay the mortgage, still got to pay it back the same as anyone else does. Yeah. But what about then if it was self-employed? How do you sort of view that then? Because I mean, I don't know what kind of self-employed people this would go for, but say, I don't know. Say myself, self-employed graphic designer. Say I come to you, if graphic designer was allowed and that was professional job, whatever that you would cater to. There's no guarantees if you don't know about this profession. How do you know that I'm not just I've got I'll get this contract now. It must be quite hard for you that way compared to when you've got the facts of the past for earnings. Do you know what I mean? It must be quite. It's a brilliant thing. It must just put a lot more pressure on yourselves and more risk in effect, does it? Oh.
Yeah. So with these, a lot of the contractors or self-employed, they've done that role before.
Okay. Yeah.
And again, we generally, I mean, I know we've overhauled it, but you would, for the professional range, majority of the professionals will have taken a qualification, so they will have taken time in that industry, in that arena. Sorry.
It's it's a good thing that,
because you wouldn't go into, well, you could go into graphic design because it's a hobby and you set your company up. But in that instance, when I pass the story across, I would expect that they would say, maybe not yet, we need some proof background, because yes, we class you as a professional. They're not saying that they're giving you a definition of a professional. What they're saying is, we've chosen these professions to be on our range that we're comfortable with.
but within these professions, you'd need obviously to be qualified or
But also, if you went down the self-employed route, you'd expect so like an accountant could be an employed accountant and set the firm up. You would want that history, which they would have, you know. But if they didn't, then that's when it comes down to an underwriter saying, no, not in this instance. Or maybe they might not get the. Am I right in thinking they might not get the stretch that they were hoping for, and it might just be a amount?
Absolutely, yeah. But again, it's assessed individually, case by case, depending on the client's personal circumstances.
Okay.
Do you putting you on the spot here? But do sports professionals come into that at all? So you wouldn't, like, because I know the Northern Rock back in the day when I worked there, they had a professional range for sports, but that was because Adam Abelgarth loved his sportsmen. No, so it's not.
The ones that we'd ideally be looking at is
Professions,
who've taken a qualification.
Yeah.
Okay.
So going back to like the buy-to-lets and the not just the professional type, the early repayment promise that you mentioned, do these things have, so obviously they go up until the lifespan of the person. Do you have is there an age range that it would go up to, or there's an age range that you say, oh yeah, you're too old, we wouldn't start? There must be some kind of ceiling, is there?
80.
Okay, all right.
As
Yeah.
application.
So that's on the buy-to-lets. Yeah.
Right.
On the holiday.
On the holiday lets, sorry, yeah. That makes sense, because that is a business and you need to be running compass mentis.
I think I used 80-year-old as being
Your max.
Well, no, I don't think it was max. I was like, well, you wouldn't want an 80-year-old coming in, but I think that's great. I think that's...
I mean, it's the buy-to-let, the way that you see it is it's there and it's going to continue to earn. And at that age, as long as you've got a tenant, it's going to get paid.
Yeah.
But there is still stress with buy-to-lets. And I think you've got to, being sensible, having an age limit. And there's lenders out there that don't. There's max age doesn't exist on certain buy-to-lets. So the good news is when we are finished with that holiday let with Hodge, there may be options elsewhere. But also it is a business, and to run a holiday let takes a hell of a lot of effort. So you'd want to retire from that, or maybe pass the property down, sell the property, do whatever. But the linking into, like you said, the ERC promise, it's just good because you don't know when. You could take that out at age 69 and think, I've got another 5 years left in me. And the tiniest thing could make you want to get rid of that property.
Yeah.
Not having that incurred penalty is good peace of mind, because a lot of people will take a 2-year fixed because of the penalty. I'm not too sure what's going to happen with thinking about starting a family else.
See, I'm a massive, massive worrier, and I would be totally risk averse, but if you've got that in there, that's a big weight off your shoulders, isn't it?
Yeah, I remember, this is completely off, it's not still on subject, but I remember TSB were doing kind of 5-year fixed or 10-year fixed, but with the penalty just at 5 years. So that allowed people to make the right choice, because everyone would take a longer term fix if they could. If there was no penalty, everyone would take a longer term fix if that was affordable, because they would then shop about. But the way you've done it is you are going to be sense checking that we can't have abuse of it. Certainly can't have people buying a holiday a property to flip it, because that would be short term lending. And there'll be people trying to abuse the scheme. But by the sounds of it, the way you guys look at every single case is you'll have a plausibility check as well. And the good news is that for a holiday let, the plausibility may just be have these customers got it in it. know that they're always in the overdraft and they're struggling to make ends meet themselves. So how are they going to furnish a holiday let that suddenly needs all new bed linen and things like that? Because them costs go through the roof just to buy towels, enough to be able to turn them around. It's that expensive.
I just think it's amazing. It's shown again, well, especially today, how many different niches and how different like sort of facets that certain people can offer that you wouldn't even think of. I think it's really good. Again, it's down to education. It's down to, well, for yourself as well. You didn't know.
Yeah, I mean,
some of these
I
things,
only,
and now you can push them. You know,
I only learn when. I mean, the good thing about holiday let lender like Hodge is they've not created and the fact that you did it before lockdown as well. That's nuts. Someone knew something there. I'm sure.
that's gonna lead me on to my final question. That,
but so I've got customers. Obviously, I can't mention them, but we've got customers with Hodge, and what it was if I went down the route of a lender who delve in holiday lets, so we could be talking like Leeds Building Society. They've got a range where they will look at holiday lets, but their bread and butter is a building society and it's residential lending for everyone else. Okay, but they have a product for it. Now, when in the past we've put products to them, properties and propositions, sometimes a holiday let looks like a holiday let, and that's where you're good. So these holiday lets could be overlooking Lake Windermere, for example. Whereas for saleability on a residential lender, their theory would be, this big risk, this. Whereas with you guys, if that's all you do, you've got many case studies there of what works. You know? So I like that you are a holiday let lender. That we said buy to let before, and you frowned as if to say we're not buy to let, we're holiday let, because that's normally you have people who dual it, but you're going down the route of, and I must say your products for a holiday let are competitive, and it's kind of like anyone who's thinking about getting a buy to let. This is the myth I'm busting. Anyone who thinks they're getting a buy to let, they're going to try that for a bit, but they might revert to an Air B&B. Then this is always an option on the table from the offset. You don't have to think, I'm going to try it with it. You could go in and run your business. That's the difference between a buy to let. Buy to let, you're a landlord, that's it.
Yeah.
This is running a business. And there is lenders out there that Hodge, and they're going to speak to you and look at you individually. So it protects you because you're making sure that you've got the right customer. It's not just throwing it at the wall and saying, yes, we like the property and you're going to put the money in. This is, can they do it? And could they afford the voids if they needed it?
And that kind of, as you say, the whole thing about it's a business and it's different from your normal buy to let, that leads us on to my last question. Have you seen a massive upturn in people doing this over the last, say just before COVID or since then? Has it kind of, is it still taking off? Is it still?
Yeah, there's still definitely demand for it. We had to see kind of tail off. And I think with the budget announcements as well. So let's see how that will pan out next year.
Yeah.
But I would always say when it comes to that, go and seek advice from a tax specialist.
Yeah.
But ultimately, we will continue seeing it grow because, again, with the cost of living crisis, we've got so many clients out there who probably still can't go away abroad. Who don't want to go away abroad because we've got so many pretty places in the UK here.
But that's something that's come to light a lot more, hasn't it?
Absolutely,
lately, I think, for people. And it is the likes of Air B&B, not an advert for them, but you know, it makes it a lot more affordable for people as well.
And
so it's
again,
two ways, isn't it?
with so many changes in lockdown, people can work from home as well. So why would you not go and take a long weekend with the family and then go and work from your holiday let on a Friday and Monday and then travel back when the traffic's gone?
Yeah, no, it's interesting because you can sort of see benefits from both sides for yourself as a recreation thing, but also from like, you think, oh, it'd be great that to have somewhere that you can use yourself and also have a bit of income from it.
But just to put a bit more, just so it's not all biased with what Hodge do, but the 90-day thing is a niche. So living in the property, there's many that would say yes, but you can't live in it. Now, that's never going to happen because you may need to travel up there to do it out, and you need to put your head down. You're not going to rent a hotel. So to me, it's just common sense. There are lenders out there like Nationwide who will allow you to, in your own home, Airbnb your own home as part of the mortgage contract for 60 days.
Well, that's so there are instances. So it's 3 months of the year in effect. You can. That's a long time, isn't it? Really.
Do you know what? When you live here, you could earn a lot of money in that week, and we've got customers that have asked the question, which is brilliant because otherwise they'll just do it. And is is it possible to? I live in Keswick. If I rented it out for a 2-week period a year, is the lender going to be okay with that? And yeah, Nationwide would. So, but that'll probably just make them think, you know what, we should do this long term, and we'll come to Hodge and we'll buy a property. But by doing that, they're paying for their own holiday by letting someone move in theirs. I mean, I wouldn't want someone staying in mine just for 2 weeks of the year. No, because logistically it would be a nightmare just locking everything up.
But do you not think as well though, it's opened up so many more opportunities for people, and I think you're always looking at a way to be almost self-sufficient, and if you can do that, make an income that's then going to pay for your residential mortgage as well. That sounds right, doesn't it? That's right, yeah.
But it's not just your residential mortgage, as you say. I mean, it also appeals to your mature borrowers who may not have a decent pension pot.
Yeah, exactly. Yeah,
and they want to fund their retirement.
Yeah, good point.
But that's all I'm.
So you could
link
that
about
to
it, won't you?
Well, obviously, if you had a young Rio at 50 coming to buy a property till age 80, they could, if they were lucky enough to be mortgage free, release a bit to use you to release the money to then purchase the Air B&B. Keep calling it buy-to-let. But yeah,
but it's things like that it's only when you get over a certain age and all you hear about is from work and everywhere is pension, retirement, blah blah blah. And more people talk about it the older you get, and I think it's having these options now that do kind of the more attractive as you get a bit older, and I think it's a great thing.
Maybe more our age.
Yeah, terrifying, isn't it?
Only what, 3 years?
Say that again?
3 years for you?
What was that from 80? Or I feel a lot older than I look, put that way.
But blowing our trumpet here, Hodge work with intermediaries for a reason, because we will be the filter to be able to say, right, actually, we've got a client that we think is deserving.
So that's another good thing, isn't it? It saves you being bogged down with people that you might do all the research and then
you wouldn't have been able to handle it in 2021 when everyone wanted an Airbnb. And it's the house next door, which is going to manage it. That would be the worst nightmare. A lot of people wanted to do it. We had inquiries of Airbnb constantly because everyone knew someone that was doing it and making a killing. But actually it did die off. And I think what it did is it got rid of the chances and people that just wanted to make a quick buck. And then they actually realized this is a business. And if you do it right, you can have a free holiday wherever you need, and you can make a really good amount. And if, like you mentioned, the budget, I don't like getting political, but
that's what I just touched.
We hope that the budget is friendly towards them, because that's what's happened in the buy-to-let market previously. Is it's not been kind, and it got rid of those people that were maybe just doing okay. And we hope that the many people that have purchased holiday lets, that they're not going to be penalised now for making that choice.
No. Yeah, because it has been favourable, but
you never know.
Yeah, exactly.
We'll find out on episode 40.
We'll have you back.
But anyway, that was.
It's been really good. It's the most notes I've ever written. I think. It is. It's as I say. It's.
I think the good thing is that we're not allowed to do a call for action. We're not allowed to say come and get in touch with us. But it just does stress that it's not just a buy-to-let. It's not going to buy a property and rent it out. You need to understand how it works. You need to be dealing with someone who's professional and an intermediary. You need to touch base with an accountant to understand the pros and cons of how to set it up. And ultimately, you're going to have a lender like Hodge who specialise in it, saying you're going to do all right in this. It's a joint venture for you, innit? You're in it too.
I think it's something again that it points out that things like that down to education again, and I think the likes of the myth busting section on your site, Paddy, I think it would be another good thing to put in there, the differences between your buy to lets and your holiday lets and things. And I think it's handy to know you've got the right vocabulary with it before you start. Because if you'd have mentioned that, I would have just put them both in the same bracket to start with anyway. Being uneducated, and I think it's been really good, really insightful. Enjoyed.
Yeah. So just on that, I take it, are your products open to people who maybe want to transition from a buy to let over to a holiday let? So as in effectively a remortgage from a buy to let, that they're thinking, I want to do this as a holiday let instead of my buy to let. Oh, that's so that you've got people that may have actually I see the benefits of doing it as a holiday let instead, which is great, because again, we don't want customers just doing it and breaching their mortgage contract, because they're going to get into a lot of trouble then. And it's good that that's not just about finding the right property. You might already have it. Brilliant. So this was episode 22. and it's season 2, episode 4. Just to complicate it further, we've gone away from the Roman numerals. I was trying to be dead clever, but we ran out of knowledge of Roman numerals, I think. And Hema, it was absolute pleasure.
Yeah, it's been great. Thanks. I'm going to go back and talk to the wife about holiday.
Just because we haven't built in our fabulous new technology here. We've got buttons that you can press, and Baz hasn't prepared it yet, but we've got jingles, we've got adverts appearing in between. So do you want to quickly put your 5 pence in that you normally would?
Yeah, becreativecumbria.co.uk for all your design, marketing, print, any kind of needs. Anything at all.
So we're allowed to promote Baz, not allowed to promote me.
No.
That was Mortgage Mythbusters. We've busted the myth. You can't get a mortgage for an Airbnb because there's somebody out there that didn't know that you could. And the key message is speak to professionals. It's a business. It's not something you should be doing lightly. And if you are going to do it right.
Yeah, very good. Thanks, everyone.
Right, till next time. Great to have you. Catch you soon.